happy one for everyone. First item is our consent agenda, and we have a motion, well, would you read the motion, Mike?
Yes, sir. Let's see. There would be a motion to adopt the proposed agenda as presented.
All those in favor?
Aye.
Aye? Okay, do we need a second?
Well, that's all right.
I think it's all
I
right.
think we're-
Okay,
I think we're
motion
okay on that one.
is carried, consent agenda is approved. Second item is the chairman's report, and I am pleased to say the chairman has nothing to report at this time. No news is good news. Okay, then we'll move on to the third item, which is the CEO's report. No motions have been received.
Yes, sir. Thank you, Mr. Chairman. I just wanted to draw the commission's attention that the meeting dates for 2016 have been published, and they were published in writing as required by state law. The one correction, though, that we'll need to make is that we got the day of the week right, but we got the day of the month wrong on the February meeting. It's actually, I believe it's Thursday, February 25th, rather than Thursday, February 26th. So we'll need to make that
So the correct date is what, Mike?
Thursday, February the 25th. We got the day of the week right, but I think the day of the month wrong. So, also to let you know that we have completed the minutes for September, October, and November. I did not want to post those and make them. I wanted to confine the items for this meeting to just the ones that we had talked about, and I didn't want to overwhelm you with written materials over the holidays. So those will probably be posted later this week, and we would be looking to have those approved in February. So also, something to keep in mind or to think about as well, we've had a request from PIBA, as I think everybody is aware. The actuaries in the process of doing the experience study, and they've inquired as to when that we thought that we might bring an asset allocation for your consideration and adoption to the commission. If at all possible, and I'm working with, Jeff and I are working on this, they would like to include any new asset allocation that we would be moving towards in their calculations when doing the experience study and their projections moving forward. So we may be looking to do a early February meeting just for that sole purpose. So just if you would keep that in mind. But I'll let you know something a little bit more about that later in the week.
I would just add that as we approach this final determination, which we expect to have at the February meeting, that as Mike is going to be talking to everyone on the commission and discussing it. So I would really encourage anyone, or all of you, if you have any questions, if you have any suggestions, if you want to discuss this, please, by all means, do that so that we can have a really thorough understanding of what will be proposed going forward. So when we get to that February meeting, we should have hopefully some unanimity of opinion.
That's all I have to report, Mr. Chairman.
All right, I guess then we will now go to the acting CIO's report. Mr. Berg, do you have a motion?
Well, we can,
Or do you want to?
we'll do that after.
You want to do that afterwards?
Yeah, after he
All right.
does the Russell
Okay,
consent.
go ahead.
Yes, sir. Consents.
If you'll recall, well, let's apologize for having a little bit out of order here. So there's one issue that we have here during my comments that requires some action. If you'll recall, in 2014, the London Stock Exchange acquired Russell Investments from Northwestern Mutual for $2.7 billion. At that time, it was widely anticipated that they would seek to retain the index business and then sell the remaining lines of business. And in October of 2015, they announced that they had entered into an agreement to sell the remaining businesses to two private equity firms, one being TA, a firm that we're very well familiar with, And this is a transaction that's expected to close in the first half of the current year now, I can say, 2016. The reason this requires action today is in order for us to maintain our existing services that we currently enjoy in our relationship with Russell, we do need to provide our consent to the assignment of our contracts. As you may know from the memo that we provided, there are two contracts we currently have with Russell. One relates to the overlay and transition services businesses that we use in the management of our plan. And the other is a contract whereby we have access to their manager research portal. These consents are necessary specifically related to the first of those contracts to allow us to continue the current implementation of the plan uninterrupted. And if I'm happy to take any questions on this matter. This is actually the second time we will have done this. We did it again a little over a year ago for the first sale. Now this is the kind of the separation of the two business lines, and we just need to do basically the same exact thing again. So I'm happy to answer any questions on this topic at this time, if there are any. Otherwise, do you want to read the
I have a
motion?
question.
Yes, sir.
Knowing what private equity firms sometimes do, is there a risk here that their objective is to squeeze out the costs with a short-run perspective, which might hurt long-run performance?
I don't have that concern. This is, just to give you a sense of the scale of cost here, if they, I guess the concern that I would have would be if they seek to raise the cost to us. Right now, we pay for the overlay basis points in aggregate. There's a small fixed cost, and then literally it's on average 2 basis points for our exposure that we have via the beta overlay program. So the concern I would have would be if somebody wanted to come in and say this is actually market price is much more expensive. I don't have concern regarding if they lean on the business, as you indicated, to turn dollars of revenue into more dollars of profit. I think that what their strategy would likely be would be to seek to broaden the business, as opposed to, I don't think that that's long-term a good business model for them, since it's very much a services business. To squeeze your clients, I think, begins to get to be maybe more profitable per dollar, but then you start talking about fewer dollars as your clients go elsewhere. So it's not a concern I have.
Any other questions? Jeff? If not, read the motion.
Yes, Mr. Chairman, the motion would be to adopt the recommendation of the acting CIO to approve the consent to assignment of Russell Implementation Services Agreement with Russell Implementation Services, Inc., and to approve the consent to assignment of the Manager Research Agreement with Russell Investment Management Company, and 3, authorize the chairman or his designee to execute any necessary documents to implement the decision as approved by the commission. Just ask for the motion.
So we'll need a motion to approve. Second?
Second.
All in favor? Aye.
Aye.
Okay.
Motion is carried. Jeff?
So we want to be as efficient as possible with your time today. At the November meeting, we had some discussion regarding the Q3 performance. However, we didn't have the full Q3 performance deck that we are accustomed to having at that time, since we had just received the data. That has been posted. But rather than spending more time on Q3, I wanted to have Josh Green provide us with an update. Since we now have data through October, I thought that made more sense. So if it pleases the commission, I'll ask Josh Green to lead us in that update.
Mr.
the reason that we've got Mr. Green sitting at the table with us and all the other presenters today is it's much easier for the folks who are joining us via telephone to hear. The microphone's closer. It gets you can't really hear if they present up there. So given that we thought we'd have a couple of commissioners joining us by telephone today, our presenters will be sitting at the table with us. So just wanted to get that out there. Mr. Green.
All right.
Sorry.
Thank you. Last time we spoke, I presented September performance, like Jeff said. It was at the end of a difficult, largely negative 3-month period, mostly drawn by a pretty severe emerging market drawdown. As you can see by the 1-month column on this table, it was a very strong October. Over the course of October, you can see GTA up 4%, global public equity up almost 8%, and emerging market debt up 3.6%. So a large rebound for the month. On a fiscal year-to-date basis, real estate is leading the charge at 4.1%. You can see our fixed income markets acting as we expect them to, being negatively correlated to equities, and that's showing in this volatile period. When you get down to the more riskier asset classes, you see them in the negative performing column for the fiscal year-to-date numbers. Global public equity, that 2.34% is actually made up of U.S. equity, which returned a positive 1%, international developed, which returned a negative 3%, and emerging markets, which returned a negative 12%. All of those three numbers wrapped into that 2.34% number. Then you have emerging market debt and commodities as the two lowest performing capital markets. Commodities returning a negative almost 15% for the 4-month fiscal year-to-date period. On the next slide, you have our actual plan asset class benchmarks, or excuse me, asset class returns. The plan returned negative 1.04% for the fiscal year. That's lagging the policy benchmark by 26 basis points for the 4-month period. And again, referring to the 1-month column, you can see that virtually all of that comes from October's return. A couple of sources of that underperformance for the month of October. Global public equity underperformed its index to MSCI ACWI. That was mainly because our U.S. small cap managers lagged the October rebound compared to the U.S. broad market equity. Besides that, you have, again, real estate leading the charge. Virtually the rest of our private equity mandates with fixed income there as well. And then you'll see a very familiar order of asset classes here as the previous slide. Slide gets us into excess return. So each asset class's performance versus their benchmark. Low beta hedge funds, private equity, and real estate being the 3 top outperforming asset classes. Private debt, mixed credit, and GTAA being the 3 underperforming asset classes. When we get to the attribution portion of the presentation, we'll talk a little bit more detail about this, specifically not just absolute return, but the impact on the total plan return.
Can I ask a question about the last slide?
Sure.
And this is maybe just to help me understand it. Like real estate and private equity, I see where private equity's got the goose eggs across there. They just hadn't reported anything, I guess.
Right, yeah, and that actually was another source of underperformance for the month of October. Got very few valuations in,
Yeah.
whereas the slide before, you can see that public benchmark that we benchmarked them to was positive.
And for real estate, when you've got 2.27, would that, do you have any idea what percentage of real estate was reported? I mean, it's on, a lot of that's on a lag, right?
It is, yeah.
So how do you
Correct.
manage this? You use a proxy, or is this the month prior coming in?
So the 2.27 is actually all the valuations that we received during that reporting period and that the bank captured. So what I can do is get together exactly, who's reported when, because that's through
You'll confuse me to get down to that level. I'm trying
Okay,
to figure out how
sure,
you do the
yeah.
math, and I'll never figure that out. So
Right,
I
right.
just trust you.
Yeah,
But
sure.
So you just don't know, but you figure what, over a quarter, or over 4 months, you're gonna catch up?
Correct, yeah, over the course of as the months get longer towards the end of the fiscal year, you'll get a full response of history performance.
Thank you.
The longer, a different way of putting it, the longer the time period you're looking at, the less skew. If you're looking at a 1-month number, it's very subject to who reported that month, but that over longer periods of time starts to be less meaningful in terms of the
But Seneca, on
overall.
private equity, is it fair to say if you have a quarter ending September 30th, you're really talking the quarter that actually ended 30 days earlier? Because of the lag. I mean, would that be more appropriate, or is it a kind of a
Well,
blend?
the way that we've constructed benchmarks, we would say that that you're seeing the statements you get on September 30th would be more like June 30th
Gotcha.
as opposed to August 30th.
I got you.
So that's why the way we have constructed the benchmarks for these private markets is to include a lag of a public benchmark, because, you know, there's not an exchange every day where
Yeah.
you get that price confirmation, so.
So we'll have November, I guess, maybe Thursday or Friday this week. Okay, well, good. Thank you very much.
Sure. This slide just breaks down, obviously, our portfolio allocations and where we are different than our policy targets. There are very minor differences in this slide from the September presentation, and we're in a pretty tight band in all of our major asset classes to our policy targets. This brings us to the attribution portion of the presentation. Attribution is a model that we built to really take a deeper look into each asset class's contribution to the plan's excess return. So when you see the total attribution here, what you're seeing is each asset class's contribution in basis points to the plan's excess return. These are additive, so that's why when you sum up the total attribution column, you get to the total value added, or plan excess return for the fiscal year. You can take a look at two different effects: allocation effect, which is the effect of our decision to be overweight or underweight different asset classes, and selection effect, which is implementation of those asset classes or investment selection. Some interesting points, you can see commodities and emerging market debt. While those managers outperformed their policy benchmarks and had a positive selection effect, the allocation effect was also positive, which was our decision to be underweight those poorly performing asset classes. So kind of an interesting point is that while those were the two lowest broad market performing asset classes, they did add to our excess return overall. Real estate's another interesting case. The managers did exceptionally well for the fiscal year, but being underweight our highest performing asset class detracted from the allocation effect, as you can see by that -2 basis points, but adding value overall. When you get to the bottom of the page, you can see an even distribution between selection and allocation that brought us to our 26 basis point underperformance for the fiscal year. And the data to the right, the asset class return, benchmark return, and over and underweight is just for your review to really try to dig into why these effects are happening. The next slide takes a look at the same exact data from the previous slide, but just a graphical sense for the visual thinkers in the room. You can see how we've stacked the effects, the selection effect being the light gray and the allocation effect being the dark gray, those two adding up to the total contribution to excess return by each asset class. And finally, we take, again, that same data, and instead of thinking of things in basis points, we try to really think of it in dollars. In this graphic, we tend to get caught up in hundreds of percentages, but seeing each effect and each impact broken out into dollars can be useful. So what you have is the large blue bar to the left, the policy ending value, and that's what our ending NAV, total plan ending value, would have been had we been passively invested in the policy benchmark. At the blue bar to the right, the RSIC ending value, is what our actual ending value was. And each asset class shows you how we made that trip along the way. The selection effect is the shaded boxes, whereas the allocation effect are the solid boxes. So seeing that hedge fund or low beta hedge funds, 16 basis points is, is kind of an abstract concept, but seeing that it added $45 million through selection effect for the fiscal year puts it into a different perspective.
And that's just, either of the blue bars are just net.
Yes, correct.
Importantly, the bar on the left is if you had just returned what your policy benchmark had returned. So that would.
That sums up the presentation. So unless there are any questions, I'm happy to turn it back over to Jeff.
Questions? Hearing none.
Thank you.
Jeff, do
All
you
right.
have anything else to add?
Yes, just a couple of things, and I'll be brief. So in the past, an issue that's come up from time to time relates to this, and I believe it's Commissioner Gillespie that's brought this up, relates to our strategy around rebalancing. And I don't know that we've ever really clearly communicated how we're rebalancing the portfolio, so I wanted to do that today. I don't want to belabor the point on the topic, but I think everyone would agree, if you believe that an asset class will outperform for a period of time, you're best off if you don't harvest your gains. You would continue to allow your investment to accrue to greater amount in that asset class because of your outlook for it. So that would be an indication that you would not want to rebalance. You would not want to continue to ride with a bigger weight on that asset class. Curiously, for an asset class about which you had precisely the opposite opinion, if you were particularly concerned and bearish on an asset class and it was underperforming, you would not seek to then, as you are bearish on that asset class, to harvest your gains on a asset class you felt better about and invested in something you didn't think was all that promising. So you would arrive at the exact same decision. Why would I take from a stronger asset class in order to invest in a weaker one? So if you expect a trend in an asset class to be the best performer or the worst performer to continue, you would avoid the temptation to rebalance. Today, as we sit here, we don't really have those opinions. We don't have tremendous conviction in any asset class's ability to be a leader or laggard. So what we are doing and what we have been doing for the last 3 or 4 months is we are rebalancing back to our targets. We see an environment in which volatility, I guess today is a wonderful day for me to talk about this. Volatility is rising in markets, and when you look at the long-term asset class forecast, it does not project any particularly strong performer. So the environment in the regime we're in right now is one in which we feel that having a tight rebalancing discipline makes the most sense.
Jeff, could you explain exactly what you mean with the threshold? Threshold currently set
Sure.
at 0.5. What do you mean by that?
Absolutely. So there are costs to rebalance in certain asset classes, and I'd refer you specifically to emerging market debt as a asset class that can be quite costly to rebalance. So if our allocation to emerging market debt at the end of a month, we felt it was maybe 15 basis points off of the target, we're not looking to just be trading to trade. We want to wait until that is a more meaningful trade such that we can then get a little bit more bang for the cost. So we have set, and it's an arbitrary level, and it's one where we have the ability to manage it more tightly than we have in the past. But when something gets outside of 0.5% off from its target weight, that's when we start seeing the signal go off that a rebalance trade is on the table. So just one further bit of clarification. I'm talking about month-end rebalancing. I'm not talking about intra-month right now, because our benchmark rebalances every single month, right? Every single month, our target weight for, take your pick, core fixed income is 9% of the plan every month. So if it does really well at the end of a month relative to the rest of the plan, maybe it's grown to be 10. At that point, there's a rebalance trade that would be implied to take it back down to 9. So does that
So,
help?
just to be clear then, so when you talk about this monthly rebalancing, does it have to exceed a 0.5% before you decide whether or not to rebalance, or I'm a little unclear?
That's the discipline that we're
Okay,
working with right now, is if it is 0.5% or more, we will rebalance. Now, we can rebalance if it's less than that, but that's the level that we have been adhering to
But
in liquid markets.
but at 0.5%, then you are committed to.
We'd move it back to the
Okay.
target weight
All right.
at that point. So I know that's come up a couple of times, and I just wanted to take a minute just to share with the commission how our attitude toward rebalancing has undergone a bit of a change here.
Do you very often rebalance inter-month?
We have, was trying
Or
to think of,
intra, I should say.
trying to think.
Intra-month,
Yeah,
not
intra-month.
intra.
I was trying to think of an example of that. I think back in the first half of the year, when there was a lot of equity market volatility, we did do some rebalance trading. It was not necessarily done from the perspective of take us back to our target. It was done from the perspective of the market's down, we want to be a buyer. So it was not with a target in mind. It was more opportunistic in spirit.
Have we already put in place the new targets for cash and public equity?
Thank you for asking. That's exactly where I was about to go. So I want to talk about two issues as it relates to asset allocation. The first being, in November, we formally changed the asset allocation targets, raising global equities by 3%, public global equities from 31 to 34, and reducing cash from 5% to 2%. I ordinarily would sit here and say I'm happy to report that this is done. However, today is a particularly painful day in the markets, so we'll just say that has happened. What we used December 31st as the date to begin that transition, so probably 2/3 of that got done before we left for the holidays, and the other third got done this morning. So there was a little bit of fortuitous timing, but unfortunately, markets are down enough that not necessarily something I really want to brag about today.
Jeff, do you anticipate in reducing net cash to the 2% target from 3%, that,
From 5%.
or from 5%,
From 5,
excuse me,
yep.
that, given the increase in short-term rates and the further increase that we're likely to see during the course of the year, will meaningfully impact those returns?
Well, there are two comments I'd make on that topic. One, when you look at what the Federal Reserve said it's going to do, and then you look at how the market responded to that, and from that announcement to the end of the year, there really was not a meaningful reaction in equities. So the second part of this is, to me, you look at what happened over the weekend, right? China has a very disappointing growth number, and or factory goods order number, and escalating tensions in the Middle East. And those two things combined, and I think it's more the former than the latter, have conspired to give us a more volatility than we saw post-Fed announcement. candidly. So I don't think that the Fed is going to necessarily, the shift in policy, I believe, is long overdue and is already priced into the markets. Now, the markets do not believe that the Fed will, the blue dots, the theoretical blue dots, where the market is forecasting rates to go is not where the Fed said this is the trajectory. So the market is still forecasting rising rates, but not on at the steepness, if you will, of what the Fed laid out as in the, I'd like to say the blue dots in their forecast.
Well, we've actually had some increase in short rates. If you look at those charts.
Yes.
Present versus
Yep.
over the last year and so forth, 1 to 5 years is definitely, the
Yep.
rates are higher, not dramatically, but
Yep.
certainly higher.
Yeah. You're not seeing the quarter point move across the yield curve
Yeah.
right now, I think so you're seeing a little bit of a flattener right now of the curve.
So theoretically, over the course of the year, that should help.
Yeah. And, this is one of those things, are you better off with the Fed with no bullets in its gun? Or are you better off with the Fed restoring a little bit of optionality and using the kind of sluggish but pretty strong growth in the economy? Broad-based, I mean, not strong in terms of headline number. Using this as the opportunity to start raising rates. I think that the market is not terribly spooked by this. So,
Okay, thank you.
Dr. Wilder, did you have a follow-on question to your question about moving the equities in the portfolio?
No, you answered
Okay.
that, thank you.
Okay. The other thing I want to point out, and I need to thank Suzanne and Tim from HEK on this, or I'm sorry, AHIC, sorry, is I'm very hopeful. We've been doing a lot of iterations of the what we referred to at the last meeting as Portfolio A, and I wanted to call this Portfolio A plus, but I thought that might be leading the witness, so to speak. So I hope to have Portfolio A2 pretty well rounded out, ideally next week, so that we can start having the conversations around, what would be the implied changes to the portfolio based on what we, in collaboration with HEK, feel is the appropriate path to move the portfolio. So I'm hopeful that we'll have that in the next couple weeks. And as we get that, Mike and I will begin to, approach each of you for an opportunity to review that in detail, so that we can make as much hay prior to the February meeting as we can. We've also started the next wave of challenging our beliefs, and this time we've selected 4 topics that I think you can all tell, based on this list, there are no sacred cows. We're going to take a look at securities lending. It's a philosophical look at securities lending, and whether it makes sense to continue there, and if so, what does that need to look like? Also, I don't really care for the timing of the second one. I don't like to talk about asset classes in this way after periods of miserable performance, but I think there's also a philosophical question that needs to be addressed here in our portfolio. What is the rationale for having a commodities allocation? What is that? What do we believe that does for us? And if for some reason we couldn't tomorrow invest in commodities anymore, what other options would we have to try to recreate what we believe the commodities are doing for us? So that's a bit of a challenge for us. I also want us to ask ourselves the really difficult questions about co-investments. Should we even bother participating in co-investment opportunities? Do they work? Do they work for us? Or do other people have an experience like ours? Or is there an opportunity that we can view this as a time where we refine how we do co-investments in service of better outcomes. And finally, this one probably isn't as interesting, but I think to me it is. Should we continue to have a GAA allocation? The reason I say this is interesting to me is because, let me explain very briefly what GAA does for us. You're hiring a professional asset allocator. And for us to be able to look over their shoulder at how they're moving the portfolio, I think gives us a lot of interesting information with which we can integrate that. We can think differently about the asset allocation decisions that we've made, and we can use that information to help us challenge our positioning at any point in time. So aside from that, what's the nuts and bolts benefit? What, in dollars and cents, what's the benefit of a GAA allocation? Is 10% the right amount? We need to go back and ask some of these questions. I don't think that we've tended to talk a whole lot about GAA at the plan level, and I don't want you to believe that this is in response to what Josh showed us, which is a disappointing last 12, 24 months. There are some big issues embedded in that. So when we were talking about challenging our beliefs, we realized there are actually a lot of other research projects that can be really very meaningful at the plan level. In a lot of cases, these are things where we don't actually have a viewpoint or a belief that really is being defended. These are projects that can be different for the most part because they represent new ground, which, really, if you were witnessing the discussion on these, it was actually quite exciting. These projects will take a little bit of time to harvest, but we're looking forward to doing the work in the fields here with these. So I don't want to belabor this. I've spoken longer than I had intended to, but I want to pause here and ask if there are any questions on either this or the prior slide relating to the challenging beliefs.
Again, I think this is a great opportunity, if you don't want to do it right now, but when Mike and Jeff approach all of you to discuss some of these questions, if you have anything that you want to add or questions, or just as importantly, any suggestions and you have any strong feeling, that's the time to express them. Let them know how you feel. If we have different opinions, they should know about it. I would just, going back to that last slide, Jeff, on the commodities angle, I think that, to me, would be an important, the second bullet point, the rationale for commodities allocation, and a better way to achieve the same benefit. I think that there could be some significant discussion on that very point. In other words, investing in the commodity itself versus
Right.
Another way to do it. Do you invest in oil, or do you invest in an oil company? There are a lot of ways to look at that.
Well, when you think about a manufacturing business, right, that tends to be a short position in commodities because they do better when the cost of the commodities declines, right? So this is just there's a lot of different ways to think about commodities, and perhaps I think if Justin Young were in here, he'd point out he's really been helpful to try to give us a better implementation of an asset class that has left a lot to be desired.
Well, it's very interesting, as we've seen in the last year, some of these things have not gone precisely the way the textbook would have indicated. Oil prices going down, transportation didn't, airlines did benefit to some extent, but railroads did not. On the other hand, if you, the integrated oil companies have done better, counter the trend of the commodity itself. So these things always don't go exactly according to script.
Well, it's risk, right?
Yeah, exactly.
That's why we get paid to take risk.
One of the things I think you need to look at is, in all these things, is particularly going forward into this coming year, in any of these classes where there is some risk. Obviously, they all have risks, varying degrees. But those investments that we make where we are taking risk, if they're in companies that at least have a dividend of any substantial nature, that can be a cushion against, in the commodity sector, for instance, can be a cushion against the commodity itself. So I think, again, that's just something to think about.
All right.
Anything else for Jeff? Anybody else have any questions? Again, please, by all means, when you're approached, if you have questions, and just as important, as I said before, if you have any suggestions, if you have concerns, please express them when these two guys talk to you, because we want to make sure this is a real departure from what we've done in the past, and we want to make sure that we make every attempt to get this right, with the ultimate objective of improving not only our absolute performance, but our relative performance. And we have every hope, certainly expectation, by going through this process, that we will have left no stone unturned in terms of what we've done in the past and what we think we should do going forward. So please enter into the discussion as you see fit. So, let's see, I guess if you have nothing further, Jeff, then we can move on to AO1. Well, I guess we need a motion, Mike?
No, we'll do that after,
You wanna
after-
do-
yeah, after Adam's presentation.
Okay, oh, Adam, okay, I'm
Yes.
sorry, go ahead.
Thank you, Mr. Chairman. And I want to express my appreciation to the commission for being willing to meet off-cycle largely for this investment. My recommendation today is in our private debt asset class. It's a recommendation for a $150 million commitment to KKR Special Situations Fund 2. The fund itself has a $3 billion target. They're currently at $2.7 billion. Will be likely the last investor in the fund. The fund has a 3-year commitment period. The fee structure is 1.5% on invested capital. We're receiving a fee break because of the size of our commitment. There's a 20% carry over an 8% preferred return, 100% catch-up American-style waterfall, which I can talk through in more detail if you're interested. 100% offset of management fees for transaction and other fees, excluding KKR's Capstone captive consulting team. The custodian is Bank of New York Mellon. The fund is hedged to U.S. dollars, and Aon Hewitt rates the fund as a buy. We're going to deviate a little bit from our normal template because I think it's important to open with some context for this investment, and I think it will help inform future slides. And Jeff mentioned challenging convictions and what we've gone through. We have challenged private debt, and as we went through that, we tested our belief in the asset class, and one of the clear comments was our strategies in private debt must be superior to the public market alternatives, and that must be clear to us up front for us to invest in these strategies. One thing that's unique about this type of strategy is there's no good public market comp or alternative to a distressed strategy. You could argue hedge funds can take advantage of some of these transactions, and they do, but mutual funds, ETFs, those entities aren't structured to invest in longer-term distressed type transactions. So there's an inherent complexity premium that exists for being willing to work out troubled credits. As you think about the KKR strategy itself, there are 4 main points that we're going to cover today of why we're making this recommendation. First is timing. We believe the credit markets will show us compelling opportunities over the next 3 years. As of November 30th, 20% of the high-yield market was trading at distressed levels. In Asia, KKR has a differentiated and very unique platform that we'll cover, and I think that's an area where we need exposure in our private debt portfolio. The strategy itself leverages KKR's core competencies. They've been working out difficult situations, complex transactions globally for decades, and so we want to take advantage of the firm's strengths in those areas. And we like the alignment here. KKR is committing a meaningful amount of their balance sheet capital and firm resources to the strategy. So the stacked bar chart that you see here represents the sub-strategies in our private debt portfolio. And there's some logic to the way they're stacked. On the bottom, you see our more senior direct lending strategies, lower risk, lower return. In fact, on the right-hand side, you see our target return profile for each sub-strategy. For example, direct lending here has a target return. These are net IRR of 6+% when they're unlevered. As you go up from there, you see these other sub-strategies that we have the opportunity to invest in and how we've constructed the portfolio. The KKR strategy will be in this distressed category here with a target net return of 15%. On the left-hand side, you can see where we've made our investments most recently, and most recently is in the last year and a half or so. And what you can see is we've really been leaning in senior toward the more, to higher in the capital structure, more senior investments, and that looks more similar to our benchmark. We've avoided investments in mezzanine, subordinated debt, but we believe this is the right time to get into the distressed marketplace and to take advantage of what we see. If you peer a little deeper into our private debt portfolio, there are two aspects that I think are worth mentioning. One is the industry exposure. We've already spoken about energy. We have a 7.3% exposure to energy. To give you a relative comparison, the high yield index is 15%, and the LSTA, the levered loan index, is 4%. So we're in between those two. We have a meaningful exposure there, but we're not concentrated in energy. And more particular to this investment is our geographic exposure. We're almost 80% invested in North America. So we think there's an opportunity here to invest in Asia and continue to invest in these areas, but also have some exposure in Asia, given Asia's role in the global economy. So how have we done? In private debt, what we did is we took the stacked bar chart you saw earlier, and we provided the inception to date returns for each of those sub-strategies. And what you can see is that generally the returns, and we're starting here with the direct lending strategies, the more senior strategies, the returns generally follow the risk. And the one exception to that is mezzanine, where we have not been compensated, I don't believe, for some of the risk that we've been taking. As I mentioned, we haven't recommended any of those strategies lately. But we've been compensated for our distress risk at 13.6 inception to date returns. We've done very little of that in the past several years, however, really since 2012. I think that's been the right call. I think the market has changed. And overall, if you look at our private debt portfolio, our 5-year returns are 8.77%. These are as of 9/30 versus 6.98 for the benchmark. So beating the benchmark and beating the assumed rate of return. On a 3-year basis, it's even better, 10.05 versus 6.31 for the benchmark. The last year has seen some volatility, so we've seen some underperformance there. But over the long run, we've been compensated for being in this asset class. Now, we're not market timers, but I did think it's important to provide some color on the current market environment. I spent a lot of time on this slide on the upper left-hand side about Asian corporate credit. Had I known that the Chinese markets would sell off 7% today, I probably would have saved myself some time. But what you can see here is the debt levels and the leverage levels and overall debt levels in Asian high yield. These are numbers from JP Morgan. You can see nearly a doubling in the amount of corporate debt that's been raised. And also the leverage levels have increased. At the same time, the margins have decreased by about 5% per year since 2010. So this portends more distressed opportunities from our perspective. On the upper right-hand side, you see a chart of the Bloomberg distress ratio since 2010. You see this large uptick in the third quarter of last year. What that is picking up is the distress in the energy sector and the metals and mining sector. So that sharp uptick has continued through this year, but you can see the turning of the markets that's the high yield market that we're seeing there based on Bloomberg's numbers. And on the bottom, I know this chart is difficult to read, but this shows the long-term high yield and levered loan default rate and JP Morgan's forecast. So this goes back to 1998. You can see the recessions here in 2000 and then the tremendous spike in 2008, 2009. But since then, it's been a relatively muted period for distress and for defaults. Now, JP Morgan, as of this time period, was projecting a doubling of the high yield default rate. Fitch came out last week with their projections. They actually have a higher number than JP Morgan. They're expecting actually 50% more defaults in 2016. So regardless of the numbers that you look at, I think the consensus is we expect a pickup in defaults.
And what, can you quantify that? Is that in percentages? That would be 4%, 5%?
Yes.
Up from 2 or 3 or whatever?
Yes. So here, this number's picking up 3% was the projection for JP Morgan for the high yield index, 4.5% for Fitch. So, and last year their trailing numbers were, for 2015, they had it at 1.5%. So doubling or tripling. Certainly not to 2008, 2009 levels, but a material increase in the default rate.
But it's still at or below the historical levels.
This is reaching historical averages from historical lows. I do want to pause there and see if there are any questions about the macro backdrop or the portfolio construction itself before I get into the KKR fund itself.
I guess I have one. Are they anticipating doing, I mean, you have the Asian high yield on there, and I know KKR,
I'm going to cover that, Commissioner Gillespie, but the answer to that is yes. And in their last fund, they invested almost 30% in Asia, and they expect that number to be similar or maybe even slightly higher in this fund.
And did I understand you to say something about the, was it dollar denominated or local currencies or
Yes,
hedged?
it's
or-
hedged, right. So
All
this
right, it
strategy
is
is hedged
hedged,
for US dollar investors.
Now, but again, that raises the question of the cost of the hedging.
Right. They use 3-month rolling forwards, that they're not trying to be too complex or creative for us. This just, currency risk is not something that we as US dollar investors want to take in this strategy.
You're right, okay. Yeah. Good idea.
Okay. We'll speak more specifically about the strategy itself. And KKR takes 3 sub-strategies that for some other managers are individual mandates, and they put them in one special situations fund. And this gives them flexibility relative to some of our other managers. There are 3 primary types of strategies here. There's rescue lending, distress for control, and secondary market distress. We'll cover those very briefly, but happy to answer questions about them. Rescue lending is sometimes described as good company, bad balance sheet. So these are companies that have a reason to exist, but have either a maturity wall issue, liquidity issue that needs to be resolved, and can be resolved through a privately negotiated loan and not through the capital markets. Distress for control is a different strategy where you're purchasing the debt with the intent of taking the company through restructuring and converting that debt to equity. For many investors, including us, this is a private equity-like strategy. This is really at the nexus of the private equity and credit platform for KKR. And in secondary market distress, what you see here is purchase of publicly traded debt, and they're anticipating some type of price improvement. They may have a variant view on the credit. There may be technical reasons why the prices are decreasing on these securities. Now, this can be a gateway to distress for control or rescue lending strategies. When you become a lender of record, you have the opportunity to access more company information, but also engage the management team. And so it may lead to one of these other types of transactions. In the bottom part of the slide, you see the characteristics of Fund 1, which was a $2 billion fund for KKR. And you can see the breakdown of the strategies that they utilized, the sector, which it's broadly diversified, as you can see, and then the geography. In this case, 29% for Asia, to get to your question, Commissioner Gillespie, and then balanced across North America and Europe. They would expect in this fund, given the market that they see now, less in Europe, more in North America and Asia. So there are 3 primary drivers for our recommendation for this fund. One is the platform scale. So if you think about sourcing for these types of transactions, KKR can source these through their global private equity and credit network, and they seek transactions where they have some type of information edge. They have 100 portfolio companies within their private equity platform. They have long-term relationships with Wall Street and with Fortune 500 companies, so they have an edge in sourcing. They also have extensive workout competencies. As you can imagine, these transactions are not for the faint of heart, particularly long-term distress for control type transactions. And so you need the resources and the support and the infrastructure to engage in these. Next is the Capstone Consulting Group. It's a captive operational consulting team that they've built out at KKR, and it provides value to the companies that they're lending to beyond just capital that they're providing. So think about this as former industry executives that can provide insight and leadership to these companies, and more than just the dollars that KKR is lending. Next bullet point is around the firm's commitment to the strategy. So alignment is very important to us when we're investing. KKR is committing up to $300 million, or 9.9% of the fund, from their balance sheet, and another $90 million from their employees. That's the largest allocation for the firm. They have the opportunity to invest their balance sheet across their platform. This is the largest allocation for the firm, and it represents approximately 8% of their entire balance sheet. They've also built a large team to support this. There's 33 dedicated members of the Special Situations team, and it's really the cornerstone of their credit platform. And third is that their Asia-Pacific capabilities. We spent a lot of time with KKR on this very issue. We invest with the largest private debt managers globally, or speak with them. I've not seen a team that is as fully built out and has the breadth of resources as KKR has in Asia. I think it's unique. It's a differentiator for them, and it's very difficult to replicate. Which actually may be a good segue to my next slide. They established their footprint beginning in 2005. They now have over 120 professionals in Asia, and you can see the breakdown of their resources in Asia. They use a regional coverage model, so they don't cover Asia just from Hong Kong or from Shanghai or from Australia. They have regional offices across there. The special sits team has dedicated offices in Hong Kong, Sydney, and Singapore. Now on the bottom, you see their Asian PE track record. I think the primary takeaway there is not only do they have a large platform there, they've invested a lot of capital. So in this case, over $6 billion in Asian private equity. And they've built out this team with local leadership, which I think is the real challenge in doing this, and that they've hired people from these countries and instilled in them the KKR mindset and discipline and grown those teams organically and locally, which is very difficult to do. So we'll spend just a minute on their performance. The strategy began investing through very large separately managed accounts in 2010. They created a fund, Fund 1, in 2013. The net IRR as of 6/30 for Fund 1 is 13.9%. And what I've shown in this bar chart is each individual deal in Fund 1, and I've highlighted in yellow the ones that are largely realized. So you can see that most are not. But on the vertical bar, which is gray on the slide, is a 1.0 multiple of invested capital, meaning everything to the right of the bar has a positive return, everything to the left has a negative return. If you look back to their 2010 funds and to this fund, about 80% of their deals have a positive return. And that's important for us because this is ultimately a credit fund. We'd like to see this consistent performance. We wouldn't like to see a venture return profile with a lot of big losers and a lot of big winners. So this is the type of profile that we would like to see and would expect through this type of strategy. One analysis that we ran was a public market equivalent, or PME analysis, on Fund 1. It's still very early in the fund, but one thing we wanted to assure ourselves of was that the fund didn't benefit from just spread compression in the marketplace, and by being in the market that they saw positive marks. As you can see here, KKR Special Situations Fund is outpacing all of the relevant benchmarks that we would utilize for this on a meaningful basis. So what it tells us is that their returns were not generated just through spread compression. I mentioned the SMAs, which began in 2010. They invested approximately $1.6 billion. Net IRR for those was 14.1% as of 6/30. The Cambridge Distressed Index is an index that we use to compare this strategy to others in the marketplace. The two funds, if you consider the SMAs their own fund, the 2010 vintage year and then Fund 1, are at or near top quartile, respectively, for both of those benchmarks. There are two notable risks that I'd like to highlight for the Commission. One is the track record. As I mentioned, their track record goes back to 2010. There are firms who have distressed credit track records going back to the 80s. So this is a shorter track record for us to underwrite. Two mitigants from our perspective. One is that this really benefits from KKR's core competency that they've developed since they began investing in the 70s. So we think it's very adjacent to what they've done well for decades. And the existing track record that we have is positive. The second risk is broad guidelines. Here, there are very few guidelines for KKR in here, so we don't have assurance of avoiding concentration risk through guidelines. We get that assurance through looking at their prior portfolios, which demonstrate a commitment to diversification. And then they have a unique oversight committee structure within the firm, a portfolio management committee that is outside the vertical of the special sits team, that meets quarterly and oversees in a way the portfolio construction to provide some second level of oversight for the team. I did want to point out for the Commission too, because it's been in the news, the SEC announced a settlement with KKR in 2015. There was a $30 million settlement related to allocation of deal expenses. It was for the 2005 to 2011 time period, primarily in private equity. We spent time on this issue during our due diligence. Both I did and Scott Forrest on our operational due diligence team. We feel comfortable with the firm and their current practices, but we did want to note it for the Commission. Just wrapping up, we believe this is the right time and the right firm, and we think it's a strategy that provides a differentiated source of return for our portfolio. I'm happy to answer any questions.
How big is the fund altogether?
The fund?
Yeah.
$3 billion.
3 billion.
With our commitment, it would be 3.
How much leverage is involved?
No leverage at the fund level. They have a capital call facility, so they'll bridge investments and capital calls early on in the fund's life, but that expires after a year or so, and there's no fund level leverage.
even when they use the equity provision, when they convert the loan to equity, or if they do?
So when we talk about fund level leverage, we think of the fund borrowing against the commitments of the fund or borrowing against the assets of the fund. I think what you're talking about is when they convert from debt to equity and then put additional the company would put additional leverage on the, okay. Certainly they would do that as part of a strategy to rebuild the capital structure once they've gone through. But I think, when we talk about leverage for a fund, I think we may view things differently on the descriptor.
Yeah, I know how y'all look at it. I don't see the difference to be risk-free. That's the difference. But I'm okay with it. Thank you.
Any other questions? If not, then we can have a motion.
Thank you, Mr. Chairman. The motion would be for KKR Special Situations Fund to, one, adopt the recommendation of the acting CIO and the Internal Investment Committee as set forth in the summary terms chart on page 1 of the due diligence report dated December 1st, 2015. Two, authorize a capital commitment not to exceed $150 million, representing capital commitment applied to investments, management fees to be billed outside of the committed capital. Three, authorize the chairman or his designee to negotiate and execute any necessary documents to implement the investment as approved by the commission. One, upon documented approval for legal sufficiency by RSIC Legal. And two, upon expiration of the 3-day business review period as approved by the commission on May 1st, 2014, or as a review period may be amended or suspended by the commission. And four, authorize the chairman and or the CIO or their designees to thereafter authorize a custodian of the funds to transfer such funds as are necessary to meet the retirement system trust funds obligations with respect to the investment.
We have a motion to approve. Second?
Second.
Motion been made and seconded. All those in favor signify by saying aye.
Aye.
Aye. Treasurer is no. Did we hear from our folks on the line?
I'll go ahead. What's the investment period, Adam, on this?
It's a 3-year investment period, and that will start at final close.
Yeah, I'll vote in favor.
Reynolds, how are you voting?
He votes for
Are you there, Reynolds? Is he still on?
I'm sorry, I voted aye. I have.
Oh, all right.
Yeah.
All right, fine. Okay,
It's safe with us, though.
only one opposed. All right, very good. So we want to move on, Mike, now to,
All right, the next, Mr. Chairman, there's a matter that we need to attend to in executive session. And if you would like for me to read the motion, I can. The motion would be to go into executive session to discuss investment matters pursuant to SC Code Sections 9-16-80 and 9-16-320, and to receive advice from legal counsel pursuant to SC Code Section 30-4-70.
all right. So we need a motion to go into executive session. Second?
Second.
All in favor?
Aye.
Aye. Okay, we will now go into executive session.
We'll take it. When doing so would not jeopardize the commission's ability to achieve its investment objectives or implement a portion of the annual investment plan. So, just needed to announce that. Also, Mr. Chairman, there's, legal advised me that there's one correction that we would need to make to the motion. In the motion, we indicated, we talked about the
Which motion are you referring to?
in refers to KKR, I'm sorry.
Oh,
Where we talked about the first part of the motion was adopt the recommendation of the acting CIO and the Internal Investment Committee as set forth in the summary terms chart on page 1 of the due diligence report dated December 1st, 2015. That actually, we do the date of the summary terms chart is usually the date of the actual meeting, so that the summary terms chart And that motion would need to reference today's date of January the 4th, 2015. So, sorry, 2016, sorry, 2016. January 4th, 2016. So, Mr. Chairman, I would just suggest that we would need just a motion to amend that accordingly, or to make that correction.
So moved.
Second? All in favor?
Aye.
Aye?
Aye.
Aye.
It's unanimous.
Right, unanimous, okay.
All right.
All right, very good. And
That's it? Okay, then if there's no further business to come before the commission this time, we have a motion to adjourn. Second? All in favor?
Aye.
Aye?
Aye.
We are adjourned.
thank you.
Thank you.
Thank you.